You know, when you're investing in bonds, things can get pretty choppy out there. And in those moments, peace of mind is, well, it's priceless. So what if your bonds came with their own built-in life raft? Today we're talking about a really cool feature that acts as exactly that.
I mean, it's a classic fear for any investor, right? You buy a bond, you feel good about it, but then the market shifts. Interest rates start creeping up, or maybe the company you've loaned your money to suddenly starts looking a little shaky, and you just feel trapped watching your investment's values start to dip.
But what if there was an exit strategy that you agreed on from day one? A feature literally built right into the bond that gives you a clean way out. Well, there is, and that's exactly what we're diving into.
Okay, so let's break down this problem, the bond investor's dilemma. At its heart, you're dealing with two big risks you can't really control. First, interest rates in the wider market could go up, which suddenly makes your bond and its lower rate look a lot less attractive. Or second, the company you invested in could hit a rough patch financially.
And this, my friends, is where our hero enters the scene. The solution to this whole dilemma is a super powerful feature called a put option. The best way to think of it is as your own personal financial safety net, and it's woven directly into the bond's contract.
So what is it technically? Well, a put option is a feature that gives you, the person holding the bond, the right to sell that bond back to the company that issued it, and you can do it at a price you've already agreed on before the bond is even supposed to mature. And that little word, right, is everything. It's your choice. Honestly, the absolute easiest way to remember this is to just think of it as an investor's escape hatch. Simple as that. If things start looking dicey, you don't have to panic. You have a clear, pre-planned way to get out and get your original investment back. So the big question is, when would you actually use this thing? When does it make sense to pull the cord on that escape hatch? Let's get into the specific situations where this becomes a total game changer for an investor. It really just boils down to two main triggers. The first one is all about the company. You start seeing headlines, their credit reading slips, and you just get nervous about their ability to pay you back. The second one is about the market. Interest rates have climbed since you bought your bond, and now you could be earning more somewhere else. And using it for that second reason is just a brilliant strategic move. Think about it. You exercise your put option, you get your principal back, and then you can immediately turn around and reinvest that same money into a brand new bond that's paying those new higher rates. You literally turn a potential loss into a brand new opportunity. And that brings up another huge plus. See, without a put option, the only way to get out of a bond early is to sell it on the open market, what they call the secondary market. And if your bond is no longer attractive, you might have to sell it at a big discount and take a loss. A put option lets you just bypass that whole messy situation. Now, to really get what makes a puttable bond special, it helps to compare it to its total opposite, something called a callable bond. And the difference between them boils down to one simple, crucial question. Who's in control? Seriously, that's the whole ballgame. It's all about who holds the power to end the investment early. Is it you, the investor, or is it the company who issued the bond? Because depending on the answer, it completely changes who benefits. Okay, look at this side by side. With a redeemable bond, the power is with you, the investor. It exists to protect you from risk. But with a callable bond, the power flips. It's held by the company. They can call the bond back from you, usually because interest rates have dropped and they want to refinance their debt on the cheap. Great for them, not so great for you. All right, you knew this was coming, right? Having this much power and protection as an investor, well, it's not exactly free. There's a trade-off, and that brings us to the price of all this security. Because this put option is so good for you, the investor, it comes with a cost. Puttable bonds are usually sold at a higher price, or they offer a slightly lower interest rate or yield compared to a similar bond that doesn't have that feature. You're basically paying a little bit extra for that insurance policy, for keeping that escape hatch ready to go. So let's pull all these threads together. Understanding puttable bonds isn't just some boring textbook definition. It actually gives you a real, tangible, strategic advantage when you're building out your portfolio, especially when the markets feel a little crazy. So let's just quickly recap the big takeaways here. Number one, a put option puts you in control, letting you demand your money back early. Number two, it's your shield against the two biggest risks for bond investors, rising interest rates and a shaky company. It also lets you avoid having to sell at a loss on the open market. And all of that makes it an absolutely key feature
for making smart moves in volatile times.
And that really is the question to leave you with, isn't it? In any market, but especially one that feels unpredictable, having a guaranteed exit strategy is incredibly valuable. It offers real peace of mind. So the question you have to ask yourself is, what's that kind of security worth to you?